All right, so welcome to this week's episode of What the Insurance. This is week 6, and this week we will be talking about the FSA or flexible spending account. For the sake of this video, I'll probably refer to it as both, mostly the FSA for short. So just so you guys know, FSA stands for flexible spending account. And this is another one of the savings accounts like we talked about last week, the health savings account. This is another option that you can use. So let's go ahead and get started. Okay, a flexible spending account, similar to an HSA, is an account where you are allowed to put pre-tax dollars away to save for your health-related expenses. This would be facilitated through your employer. They typically have an FSA administrator that will allow you to put this money away into this account where they hold the money for you, and they give you what we call a smart debit card that you can use to cover your health-related expenses. Now, it's a smart debit card, which means you usually cannot use it for like a TV. If you go to the store, it's gonna stop you from using the card if you're using it for something that does not qualify as an FSA expense. So the FSA is for flexible spending accounts for health-related expenses. Remember, your health-related expenses are not just your medical. It could be dental, vision, prescription as well. There are some restrictions to the prescriptions we'll talk about in a brief moment. And as well as some restrictions on the dental and vision, the medical use if you are on an HSA. So if you have a high deductible health plan and you have an HSA, you would need to use the limited purpose FSA, which is for dental and vision expenses only, because the assumption is that you would use your HSA funds for your medical. I'll talk about a limited purpose in a moment. Okay, flexible spending account, put money away pre-tax. They give you a smart debit card that you can use for health-related expenses, not limited to medical, but also dental, vision, and prescription. Okay, this type of account is called a use it or lose it account. Why is it called that? Well, because the money you put in that account, you don't necessarily own like you do with an HSA. Okay, so you have to use the money by the end of the plan year. Otherwise, it disappears. It just goes away. Some companies offer a rollover option or a carryover option. The rollover option, the run out option. There's a run out option or a carryover option. The run out option is an opportunity for you to carry over a certain amount of money into the first 3 months of the year. So they'll allow you to use your FSA account or the money in your FSA account into the first 3 months of the next plan year. So if you don't finish it all that plan year, you still have 3 months or up to 3 months to use the money that you had from the previous plan year, that 3 months into the next plan year. So that's a run out period. After that run out period, it goes away. Again, use it or lose it. If you have the carryover or rollover option, that means that your plan will allow you to carry over a certain amount of money, usually up to $500, into the next plan year. So that does not end after the first 3 months. That'll go through the whole plan year. So you can add that to what you're putting in for that plan year. That's the carryover option. Not all FSA administrators allow either of those options, so you want to make sure you check with your employer, HR, as well as your FSA administrator to verify what plan design you have, and if you need to spend that money by the end of the plan year, or if you have the option to carry it over, or if you have the option of a run-out period. But in most cases, you want to assume your flexible spending account is use it or lose it. So use the money. Or like I tell people in these meetings that I do, my open enrollment meetings, you'll be buying a lot of Band-Aids at the end of the year for Christmas because you'll be running out of that money that you put away. So you want to make sure that you think about it at the beginning of the year when you're making your election. What do you think your health expenses are going to be? Do you know you have a surgery coming up or a heavy dental procedure? You know it's not going to be covered fully by your insurance, or maybe your children need braces. You know you have something coming up, then yeah, you want to put some good pieces of money in that account. But if you don't see yourself having a heavy duty spending year, then don't put too much in there if you think you're going to not be able to use it by the end of the year. Another safe bet is if you don't think you're going to have a whole lot of expenses that year, you could maybe just put in what your carryover amount is. So if you have a carryover option and you can carry over up to 500, maybe just put the 500 in just to see how it goes. That way, you know you're not losing any money. But just be careful. Make sure you want to plan out what your expenses are going to be that year so you know what to put in that account so you don't lose that money. Okay. Let's talk about, you can use that fund, like I said, for prescriptions as well, but there are some restrictions. with your prescriptions, you cannot use it for over-the-counter medicine unless it has a prescription by your doctor, okay? So just like with the HSA, you can't just go in and swipe your FSA for Tylenol unless your doctor has given you a prescription for it. So you want to be careful. You can always ask your pharmacy. The cool thing about the FSA is that, like at a Walgreens or even a Target, if you go, the receipt will show you what is FSA eligible. So you know, like if it's a vitamin that might be FSA eligible, it may be something on in the pharmacy area, like a blood pressure cuff. Recently, I found out that the bed pads I use for my son, because he's still, getting potty trained, those are actually FSA eligible. So you never know unless you ask. You can ask the pharmacy to check it, and they can tell you if it's FSA eligible. You can also ask your FSA administrator for a list of potential expenses that you can use the card for. But remember, it's a smart card, so it won't let you swipe something that's not eligible anyway. Okay. You can use this card or this account if you are covered by any of the health plans. You can be covered by an HMO. You can use the money in your account to cover your copays. You can be covered by a PPO. You can use the money in your account to cover your copays or even your deductibles. You can even be covered by a high deductible health plan. Okay, but remember, if you are covered by a high deductible health plan and you have a health savings account with that, then you would qualify for the limited purpose FSA, which again we'll talk about in a moment. Not the full-blown FSA, but you can be covered by any of the medical plans. Unlike with the HSA we talked about last week, you cannot be covered by all of those plans. You can only be covered by a high deductible health plan that is HSA eligible. So FSA gives you a little bit more flexibility in terms of the plans you can have in conjunction with that. Also, like we talked about the HSA, you can use the FSA for your dependents as long as they are IRS qualified dependents on your taxes. So you can use the money in your funds to cover those dependents as well. Copays, if they may be on a different plan, or things like that. If they're not on your medical plan, it's still okay as long as they are IRS qualified dependents. Okay. So the other thing to note is you don't necessarily own this account. So if you leave the company, unlike with the HSA, this account does not go with you. You lose that money. So be careful about that. The other thing to note is when you put the money in that account, this is a big difference between the FSA and the HSA. We talked about last week, the HSA money accumulates over the years. So when you put the money in that account, it's not necessarily readily available on day one. Well, with the FSA, it is. So if you make an election at the beginning of your plan year, whatever you elect, even though it's going to come out over each pay period, that money you elect is available on day one. So if you say at the beginning of your plan year, January 1st, or whatever that date is, you want to elect $500, that $500 is available on January 1st, okay? But it's going to come out and be divided by each pay period and come out on a pre-tax basis out of your paycheck. But it's available on day one, so that's a cool feature. However, there are some catches. On the flip side of that, if you make an election at the beginning of your plan year, you cannot change that election throughout the year. So how we talked about with the HSA last week, if you get in an accident and you only elected to put like $1,000 in at the beginning of the year of the HSA, you can change that and increase that election throughout the year if you need to. With the FSA, you can't. So whatever you elect at the beginning of the year, it's available on day one, but that's it. You can't make any changes throughout the year. The IRS does have rules around the amount of money you can put in this account. Like with the HSA, there are limits. So with the FSA, the limit is $2,700. So $2,700 is the maximum you can put in your FSA account in a given year. And remember, unless you have a rollover or run out period option, you cannot carry that money over into the next year. So be careful when you are budgeting for your expenses. Okay. You also want to make sure you keep track of your receipts in case you are audited. A lot of the FSA administrators do have mobile apps that will allow you to put your receipts in and keep track of them electronically, so you don't have to save the paper receipts. But ask your FSA administrator if they have something like that. And if they don't, you are responsible for keeping track of your receipts in case ever you are audited and the IRS thinks you are not spending your money on health-related expenses. Even though it's a smart debit card, you may still be reimbursing yourself for unhealth-related expenses. And if you get caught and they audit you and you don't have receipts to prove it, did I say non-health related expenses? Sorry. If you get audited and you don't have the receipts to prove it, then you could potentially be up for some tax penalties. So you want to make sure you are keeping track of those receipts in case ever you are audited. Okay, now let's talk about the limited purpose FSA. The limited purpose FSA is the account that can be paired with an HSA. So if you have a high deductible health plan and you have a health savings account, then you can have a limited purpose flexible spending account. That means on the limited purpose flexible spending account, you can only use it for dental and vision expenses, okay? The assumption again is that you would use your HSA funds for your medical, you would use your limited purpose FSA for your dental and vision. Now, last year was my first year giving the FSA a try. I had a full-blown FSA. This year, I stepped out on an even further limb and tried out the HSA, and I like it. And we have a limited purpose FSA that we use for our dental and vision expenses. So it's working out. So I'm speaking from experience. It's definitely something that can work. Another option as it pertains to the FSA is the dependent care FSA. That account, not to be confused with using it for health-related expenses for dependents, is actually to be used for caring for your dependents. So you can use that to cover the cost of daycare, after-school programs, and things like that. And the government will allow you to put money away, believe it or not, on a pre-tax basis that you can use to cover the cost of care for your dependents, IRS qualified dependents. That means if your parents are IRS qualified dependents on your taxes and you need to put your parents in like an adult daycare or something that you need to pay for, then you can use the dependent care account, dependent FSA to cover that as well, as long as they are IRS qualified dependents. There are some different rules around the dependent care FSA. The limits are different. I believe the limit this year, yes, it's $5,000 or $2,500 if you are married or filing separately. So that's the limit for the dependent care FSA. Also, another difference is with the dependent care FSA, that money is not available to you on day one. So like with the FSA and the limited purpose FSA, the election you make at the beginning of your plan year is available on day one. On the dependent care FSA, it is not. It accumulates, and then you can reimburse yourself for the expenses you have incurred as the money accumulates in your account. So you do have that option as well. Okay, so I'm at my time. This is intended to be very high level. Make sure that if you have any questions, you talk to your HR. You can also talk to your FSA administrator. You can feel free to inbox me if you have any questions. I hope you guys found this to be helpful. Join us next week. I have some interesting topics to go over with you guys. We're going to talk about open enrollment. We're going to talk about qualifying events. We're going to talk about a lot of different things as it pertains to getting enrolled in your plan. So I have some exciting information to share next week. Join me. Remember, all my videos are posted to my YouTube page. Link is below. Please feel free to like and subscribe. Also, I post some cool things on Instagram. I'm still learning this whole vlogger Instagram thing, but check me out on Instagram at what_the_insurance. I promise you'll like it. Join us next week. Have a good one.